there are lost decades. We know this from history. And it's not just a nice thing on a chart. It is a painful experience for someone that has done a good job and built a foundation to witness that and suffer that. Maybe it adds another 10 or 15 years of working life to their picture. This is real serious stuff. A lot is at stake, and it's not crazy to think about reducing risk, even if you're younger.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for one of our special monthly summaries with the team from New Harbor Financial. They're on this channel with me every week, usually following one of our big interviews. But every month now for, guys, I think past 6 months or so, we've had a dedicated episode just to you guys, catching everybody up on your general outlook, what you're seeing in the overall markets, what you see lying ahead. That's what we're going to do here. Folks, I'm joined as usual by lead partners at New Harbor, Michael Preston and John Lodra. Gentlemen, thanks so much for joining me this week. It's not like there's anything to talk about, guys, huh?
Oh boy, Adam, what a headline-driven world we live in today. Whether it's obviously the war, and that's nothing to laugh about, of course. Lots of developments going on in the Middle East and Iran and broader area. Headlines about AI, private credit. There's certainly no shortage of things for headline-driven investors to be watching and worried about. We generally will tell folks don't ever trade headlines. And instead look at data and let market signals guide things, and we've certainly got plenty to talk about there as well. But yeah, it's been a very active headline-driven environment. The markets so far, even though they've been pretty volatile of late, are still just low single digits from their all-time highs. So these things probably aren't fully priced in if they're destined to become bigger issues.
All right, well said, John. Mike, you want to give any introductory words before we just roll up our sleeves and dig in?
I just want to say it's good to be back. It's been a little while since we talked, and there's a lot going on, and really not that much damage in the indices if you look at the raw data. But let's dig in and see if we could see what some of the nuances mean and explain some of them.
Okay. Well, why don't we start with the big news, which is, I think, since the last time you guys were on the channel, which was just last week, the U.S. and Israel have gone to war with Iran. Implications. Obviously, this has created some market volatility. It has sent the price of oil spiking, and on the day that we're talking here, Friday, the price of oil has continued to jump higher. One, because Iran has been threatening and in practice, I think, kind of closing the Strait of Hormuz. There's very little getting through there right now. But also the day we're talking, the president announced that he's not really open to negotiations with Iran. He doesn't want to hear from them until they're ready to talk about total capitulation, total surrender. And that obviously made the price of oil jump pretty substantially after that was declared. So, yeah, gentlemen, while we're seeing some immediate, volatility in the market in the first few days of the war, how big of a deal do you expect this to be market-wise? And I'll let whoever wants to take that can start here.
Yeah, I'll just chime in. So this week is easy to summarize in terms of what's happened so far. You noted oil prices have jumped quite dramatically, Adam. The U.S. dollar's rallied pretty considerably as well. More or less everything else has sold off to some degree. U.S. stocks, non-U.S. stocks, precious metals, Bitcoin, bonds. It really is almost two things have been the only things relatively immune from the action this week, anyways, and that's again the U.S. dollar and oil. Now, those are short-term factors. We obviously think about much bigger things, but we have seen some not utterly concerning, but some minor and moderate degradation in the battery of indicators that we look at. So we haven't really materially changed our allocations at all, in fact, but we have added some tail risk hedges in the form of puts, and we can talk about that as we get further in. But not a whole lot of action in the market thus far that has us too concerned about. Mike, I think, mentioned we're just a short, bit from all-time highs, and we can certainly dive deeper into that. And Mike, please add on to what I just talked about there.
Well, I don't know how many of your viewers were checking the silver or gold futures the night before the market opened. I think it might have been Sunday night. And I was noting that silver futures were up in the high 90s, like 96 or 98, and they're down around 80 now. And that's a huge move down, about $20 from the pre-market high. And that just goes to show you can't invest on knee-jerk emotions. You can't jump into the market after the news has already broken. Now, that's not to say that I think silver is in a bearish movement here. In fact, I'll share briefly a quick chart of what silver looks like right now. And here's the ETF of silver coming up. We had this big move up to about 118 spot silver, I think it was. It was just kind of crazy, and everyone was jumping in. And that was a little bit too much too soon. Now, it might be tempting to think that that's the ultimate top. I don't think it is. Certainly not certain it is, and I really don't think it is the ultimate top. But this was one of the biggest drops I've ever seen in my career of any asset or any commodity, I should say, in one day. It was about minus 40%. And since then, we've been walking up along this 50-day moving average, and I drew this trend line here, and I realized you can draw trend lines with a really fat pencil, and different people might draw them differently. But this is how I see it. Silver tried to get up here and then was knocked right back down. This is really pretty indecisive here. I don't really know what's going to happen next. I don't think anybody does. We could easily have like a lazy try at a lazy W double bottom here and then a bounce, or we could bounce right from here. I can only say that right now, if you just cut out this parabolic move, silver's been in a nice uptrend, at least on the daily chart. It looks very similar on the weekly and the monthly. But people that jumped in Sunday night, they got really hurt really quickly. So you can't, particularly with silver, you can't jump in after the news. You have to have a position that's reasonably sized for you mentally and financially, and one that you can sit with, because big bull markets, and silver's one of them, and I think miners are another one. They will do everything possible to try to shake you off. You can't make big money easily. The market won't allow it. You really have to be committed.
All right. So what's been interesting about this, at least to me, is that when the market gets nervous, things sell off. And John, you said pretty much everything but oil and the US dollar have sold off here. Interestingly, bonds have sold off as well, right? Oftentimes you think there's going to be a flight to safety and everyone's going to rush to the safety of US Treasuries. Not the case this time. And I guess maybe let me just stop there for a second. Why do you guys think that's the case? Is that because oil has jumped up and the bond market is a little bit nervous about future inflation expectations?
Yeah, I'm not really sure. I guess I'll take a stab at that. And while I'm talking, I'll bring up the chart of TLT, and I'll say that most of what we do is technically based, Adam. So I'm not really sure if I can come up with a fundamental answer of why this happened, but I can tell you that here's a downtrend in TLT, which is 20 plus year treasuries. Big breakout of the downtrend here just a few days ago. And if I were to pull up 10-year yields, you'd see that we went through 4% finally. I think we touched like 3.96. In fact, I could bring that up in just a minute, but take a look here. We broke through the 90 level, 91 almost in TLT, and fell right back down to where we are now at 89. This is not, it's a pretty big move, I guess, in TLT, but it's not really technically damaging. We're still holding above support. To me, we're backing and filling. And so, we'll see. You would have expected a bigger flight to safety, right? With what happened in Iran. But, personally, I think that this is a relatively bullish development. And I'll take a quick look here at the 10-year just so you can see that too before we stop sharing this. And here's the 10-year. It broke through, touched 3.96, and came right back to 4.1. So we're in this big sideways consolidation. I'm surprised we got back to 4.15 or 4, I guess 1.1 right now. But still, I think that yields likely go lower.
Okay. John, do me a favor, if weigh into that any way you like, but if you can, pull up the a chart of the S&P here. And what it'll show is that the S&P has basically been trading in a trading band since Halloween. So it's been months and months of it really not going anywhere. And I think a big part of this has probably been due to the rotation that we've seen from growth to value. But you guys were talking about some not a breakdown, but deterioration in some of your technical stuff. Curious to hear what you're thinking about, whether we're going to continue to be range bound or whether you're starting to see or think you're starting to see a topping process here. So I'll let you comment on this any way you like, but my question for you is, let's assume for a moment that the war in Iran wraps up quickly. What kind of bounce would you expect, if any, in the markets from that?
Well, so I don't have much to add on what Mike already said about the bonds. I think perhaps there's a little bit of an inflationary spike in yields in the last week, with the rise in commodity, oil prices particularly. But I don't have much more to read into that. It's kind of a pretty modest move in the grand scheme of things. And we've remained, fairly quite a bit underweight long-term bonds for a lot of different reasons. But look, we opened up this morning. We were not even 4% off of all-time highs. So, there hasn't been much of a sell-off in the stock market as a result of this news of action in war in Iran. At least the U.S. stock market, foreign markets have sold off a little bit more substantially, not in a concerning way because they actually, frankly, were quite short-term overstretched to the upside leading into this news. So it was natural that they were going to pull back, and maybe the war news kind of just accelerated that more abruptly. So I don't know that we would expect a dramatic spike on any news of a quick resolution. Honestly, I think there are other factors here at play that may be dwarfing things. Things like, there is emerging stresses in
Private credit?
credit that I don't want to emphasize, but they have very similar, echoes from what we were seeing in the lead up to the housing bust, with a fairly small number of funds, kind of making some quiet, headlines about closing redemptions and marking down assets, and we're starting to see more evidence of perhaps a systemic and more broad issue with that. So. It's hard to imagine a substantial bounce, knowing that we haven't had much of a sell-off here on the news of this market, and we still remain at very, very nosebleed valuation levels by any historical metric. But the simple answer is we don't know what's going on. I mean, we're not geopolitical experts. We're not going to be one of the folks that gets on a video like this and claim we know what's going on in the chess game out in the Middle East. All we can do is watch our signals, and I'll just bring up the chart of the S&P again just to kind of emphasize, what you just talked about. Yeah, we go back. This is the S&P, the cap-weighted S&P index. That is what most people think about. You go back to October, basically, and we've kind of hardly gone anywhere higher since then. That's on the cap weighted, the one that, again, most people quote. And I'll come back to this in a second. But if you look at the equal weighted S&P, which same 500 stocks, but they're just equal weighted rather than the top 10 representing over 40% of the index, we've actually had quite a substantial rally. And this speaks to a lot of stealth things going on underneath the surface of the market that many passive watchers wouldn't be noticing, but we certainly have in our system. We have exposure to the equal weighted S&P, not the cap weighted, and we do have exposure to certain sectors that have actually done quite well relative to the broad market in the last several months. And this is not a backward looking statement as much as a statement to say that there are opportunities to, we think, with an adaptive approach, ride trends that are, even when the market is kind of stalling, there are trends that emerge. Like, for example, material stocks have been very strong over the last several months. Financial stocks have been weak. These are little subtleties underneath the market surface that a casual observer maybe would have missed. Just going back though to the cap weighted, I will say that we have this dotted line here. This is a level that we have we actually just this week on some, very modest, not utterly concerning degradation in our broad band of indicators. We put some out of the money put options on to essentially hedge about a third of our equity market exposure. If we were to see material, further weakening in the market, this is a key level, 6,500 on the S&P. That would, very quickly kick in as a tail risk hedge to take a good bit of our market exposure off. And we prefer that because, frankly, it's a very, with this tight range, it's very likely that, we may see some whipsawing of market action. These false signals, frankly, in this tight range, the traditional logic is that you're likely to see a convincing breakout one way or the other, to the downside or upside. And frankly, we're not convinced as to the downside quite yet, even though the recent action has been that way. But we're prepared if that were the case.
Okay. Do me a favor, zoom in on here. Uh, and I guess as you do, let me just get back to the question I asked you there. Let's assume the war in Iran ends quickly and favorably. How much of a bounce, if any, would you expect in the market from that?
Well, if you assume the pullback from all-time highs was, first of all, right here is where was the news? I guess the news was last Saturday, was it?
Yeah, a week ago.
Yeah, so it was right. I mean, we're barely off from, going into that weekend. The market closed on February 27th at 68.80 or thereabouts. Here we are at 67.57. We're not even 150 points off the closing high before the news of the Iran action was unfurled. So there's been barely any market sell-off reaction to the war news. So, whatever degree of war one is pricing into the market, it's been a pretty, almost negligible amount of sell-off. So, therefore, I don't think we can say that a resolution to that would equal X percent move. Generally, when the market's on an uptrend, things move disproportionately to the upside versus the downside. So it's probably a decent assumption to think that we may bounce more than we sold off on the news. But that's just kind of a qualitative speculation on my part.
Okay, but impact sounds like you're saying probably pretty mild. Okay, so sorry, bring the chart back up because I got a couple of chart questions for you here. One, on the day we're talking, and the market has not closed yet. There's still about an hour and a half left. But the markets did drop below the 100-day moving average. Is that the purple line?
Well, what I have here, this green line is the 50-day moving average. The light blue, if I might call it that, is the 21-day moving average. It's notable that those have converged, and the 21-day is very short-term moving average, but it's on the verge of, crossing over. You may call it a death cross, if you will. This orange line is the 200-day. So, in the short term, we're hovering between these key moving averages, the 50-day and the 21-day. All else being equal, we'd want to see that, reverse to not be more concerned about a continued stall or downtrend here. But, we're so far today, this is a daily bar for today. We're well off the lows. See this tail here? That's where the low of the day. It's, far off the low. That the bottom of this red box is where we are right at this moment. So it's considerably off the lows of the day. We might see a rally into day end. Who knows? We'll see. We still got at this juncture about an hour and a half of trading on this day. Yeah, so we're below some key moving average here. We're a little oversold on a short-term basis. This right here is a lower Bollinger Band. It's a 2 standard deviation metric below the 50-day. Now, those are tight because it's been such a narrow range. Generally speaking, when you have a narrow range like this, it's like a coiled spring. It's going to bounce forcefully one way or the other. So far, there's been a very muted move to the downside, but that could easily be reversed. Point being is we think there's a decent chance that we break strongly one way or the other. Right now, the leading indicator is that it's kind of leaning to the downside, and that's why we put some very modest protection on the downside. But we could easily see this recent high of 7,000 or so be taken out if there's some resolution on the war, if there's some abating of these doomsday AI headlines that had the market rattled a little bit, the private credit stuff, tariff saga. There's any number of things that can get people's attention, off what to worry about and just go on our merry way. But that's to be seen.
All right, so a couple of quick questions here. So, all right, so that purple line where the stocks are currently trading right now is a lower Bollinger Band. Just assume for a moment that we close below that today, right? That would be the first close below it in this data series, which goes back to October. How much would that concern you, or would you want to see a few more days of it closing below the Bollinger Band before you started to really worry?
We're really mostly concerned about maybe the 6,500 level, which is where we put our put strikes.
Okay.
Anything between here and there, we're not too concerned about.
Okay. All right. All right, and then zoom back in again, maybe just try to get to around July of last year.
Yep.
So zoom out just a little bit more. Go back in one more.
Here we go right here.
Yeah, yeah. Zoom in just one more again. Okay, that's probably pretty good. This may be a naive question, but as I look at this chart, especially as it's been, starting from around October, a little bit before, kind of stuck in this trading range, I think I see more days where the market dropped by a lot than when it rose by a lot. So bigger red candles than I see bigger green candles. Does that in any way make you worry that like, God, this is a market that's just really is starting to feel gravity and it keeps getting pulled to the downside. And yes, it then rises back up and then it gets pulled to the downside again. Technically, does that mean anything?
I don't think we read too much into that, Adam. And
Okay.
to be fair, one of the, obviously software stocks have gotten hammered. The broad tech space has gotten hammered pretty good, but especially the software stock sector, and that's in large part due to the developments on AI. Basically putting theoretically putting programmers out of work, and you don't need to hire programmers anymore or pay SaaS software fees because you can just create your own software by talking to an agent, an AI agent.
Just
Very
vibe
much
code.
overhyped, we think. But honestly, software has kind of we don't necessarily think it's undervalued, but it's actually been a pretty stable place in the last handful of days. It's actually kind of actually rallied in the last handful of days where the broader market hasn't. Mostly because we think it got overdone in the short term. Kind of a bottom fish rally here. I don't think it's a pound the table value that some people do. And we can get into that later. But I think the cap weighted S&P sluggishness has been largely because the Mag 7 and the big hyperscalers have been a bit under attack here with some of these headlines.
Right. All right. So, Mike, let me ask you a question kind of on this theme. Um, so markets have been sideways for a bunch of months, as we've talked about, and that's been as this rotation into value has been going on. And personally, I'm not that surprised by that because um, while the value stocks have actually done quite well. I mean, you've got some value stocks now that are kind of hard to call value stocks, Walmart being a great example, just given the PE that it's trading at now. Um, but the software stocks and the AI stocks, the hyperscaler stocks, they're so big that it's hard for the value stocks alone to pull the market higher if the big tech growth stocks are languishing as they've been doing. So that sideways action, it doesn't surprise me. They're kind of like sort of counterbalancing each other off. If just assume for a moment that the pendulum starts swinging back the other way, where the market says, you know what, these value stocks have gotten too richly priced, and now some of these software stocks look a lot more attractively valued because they've sold off so hard. If capital starts swinging back into growth, like the big growth tech companies, should we then expect that maybe the S&P will then start to really move upwards and maybe could have break out to the upside simply because of the math that when you have the big guys start to rise, that counts for a lot more than the smaller guys coming down.
I think so, Adam. I'd like to share a chart of year-to-date returns of various sectors and maybe it'll illustrate what's been going on here and some surprising things under the surface. Like you say, the value stocks, the dividend stocks, they've come back to some extent over the last few months. But it's been a really tricky market. I think a lot of people that watch this daily feel like they're a little bit crazy because the S&P will be up 50 points one day, then down 50 points the next day, then up 50 points the next day. Those charts that we just shared on the S&P essentially show that we've gone nowhere since September. If you look at the NASDAQ, it's really since late August or September in a very tight range, basically a triangle. And now the first thing we've seen here in this week is that we broke to the downside out of a congestion range or a triangle. Now, a lot of times the market will head fake, and we don't know. We could get some news over the weekend, and we could pop 100, 150 points and be testing all-time highs again. So that's been really, really challenging. It's been hard for traders. Let me share this chart and just go through a couple pieces of data here. This data is as of March 3rd, 26, going back to the beginning of the year. If you look down here, the S&P 500 is essentially flat on the year, down 0.42% as of the third. Take a look at what has been lagging. Bitcoin, actually the worst on the list, Bitcoin minus 22, software minus 18, technology, as you just talked about, and pharma and a little bit down is consumer discretionary. So these are the big behemoths, the Mag 7, they're all right in here. Take a look up here. What all of a sudden took off out of nowhere is energy. That's a pretty new theme over the last few months. And this is even before the big jump in oil this week. Gold mining, gold and silver, that stuff's been doing well this year and all of last year. As you can see over here, that's no surprise. 2025 numbers are over here. But industrials, consumer staples, these are the dividend stocks that you're talking about. Emerging markets or EEM, for instance, if you take a look at that, ETF is up 13%. Look at this, utilities. Utilities kind of fell down. It was one of our weakest sectors for a while. All of a sudden, out of nowhere, it just went vertical, and we're glad we kept it. We got close to our stop limit a couple months ago, but held on to it. Now, real estate and home builders are starting to come back. So, and here's the equal weight S&P, as John mentioned a little earlier, that's up 5 and change percent versus down 0.5%. So, yes, if technology starts to take off, if banks start to take off because they've been laggards, take a look at ETF XLF, it's been languishing. But if these things start to come back, absolutely everything will start coming up. And maybe I could put it a different way. If we broke up out of that triangle, if this was really a head fake down and we started to go up and test the high, we're only 3% away. So it's not going to take much to create like a short covering rally, and everyone's going to be looking at this thinking it's a breakout, and that will just kind of feed on itself if that happens. And so all of this stuff will do better. That's why it's a really tricky market. It's really, really caused a lot of head fakes, and so it's difficult to say what will happen next. But this stuff down here, if it started to come back in again, yes, the entire market would likely go and test new highs.
Okay. Hey, one thing I want to underscore here is, and that chart's a really great validation of this, is a lot of the experts that I've been interviewing on this channel over the past year or two have been saying, look, we are, for a whole bunch of reasons, we are likely to be entering a period where market's likely to be more volatile, but also future returns are likely to be lower than what we've experienced over the past, let's say, decade or two, right? And you guys have oftentimes shown charts like John Hussman's charts that show that given where valuations are, you know, future returns for the next 10 years might be negative, right? Average annualized returns. And so what that says is, all right, well, if you're just going to take the set it and forget it passive strategy that has worked so well for the past couple of decades, if indeed the Hussmans of the world are right, you're likely to be really disappointed going forward. You may have a lost decade, more or less, in your portfolio. That doesn't mean that you can't have good returns, but to do that in this type of environment, an active approach is much more likely to give you those better returns. And you're showing here, the market's gone nowhere since February, as you guys were saying. If you were in the right sectors, you actually could have done great, right? Just with that chart that you showed there, Mike, right? I mean, there's actually a lot that has performed really well this year. So, maybe the days of just buying the S&P and just saying, hey, all boats rise and the S&P is just going to go up like clockwork every year. It's gone up 20% the past 3 years in a row. Why not the next 3 years? I think people are starting to maybe get the memo that, you know what, maybe adopting an active approach may be the superior approach going forward.
I hope that's true. I think that's probably true. It's been so long, really going back to the GFC, at least, and maybe longer, that this market has been supported by just endless Fed intervention. So it just has felt like the only thing you need to do is be passive.
Right.
But
And the
being
passive
passive
bid,
now,
right? Mike Green's passive bid. Yeah.
the giant mindless robot, right? I
Yeah.
think is that what he calls it?
That's what he calls it.
And
Yeah.
since you talked about it, I'll just show you John Hussman's latest chart from 12/26/25. This is the dot plot that shows non-financial market capitalization divided by gross value added. This is his twist or his adjusted market cap divided by GDP. He likes this valuation metric because it's the most highly correlated to future returns. Future returns being the subsequent 12-year nominal annual returns. So down here, you can see that's -6. Well, we're actually off the chart as of December 26th. So this is a couple months old, but it's still very relevant, particularly because we're in the same area. So this essentially implies -6% returns annually over the next 10 to 12 years, which is kind of crazy to even think about. But who
Right.
knows if that's going to be right? But that's just insanity. And it's just been that way for a very long time.
Right. And just to underscore for folks, it doesn't mean that John is predicting like clockwork, you'll get a -6% return every year. It'll probably be something like, yeah, the market might be up 5% this year, but then maybe down 30% the next year, right? I mean, it's going to be much more volatile. And again, that's where an active approach can really help you, especially if that active approach, includes hedges and some other strategies that can protect you from the big downdrafts. John, you're nodding as I'm saying this.
Yeah, that's right, Adam. If you look at the handful of lost decades we can observe going back to even the late 1800s, they never happened by a sideways pattern. They're always defined by bone and soul crushing drawdowns in the markets that keep even the most stable folks up at night. And even worse than that is usually those drawbacks that cause them to get shaken out, which results in them getting out of the exact worst time. So what otherwise was a lost decade becomes a big negative decade. Loss
Right.
is a benign way to put it. For many people, they're not even able to get just a lost decade. They witness a utterly devastating decade. And yeah, if the math is anything resemblant of history, we're in for a likely scenario that looks something like that. And the point, like go to the tech bubble, crash in 2000. Yeah, the S&P lost. It was negative return for the next decade from the 2000 peak. But there were plenty areas that did well. Natural resources, small and mid caps did much better on a relative basis. Non-US stocks did pretty well. So it's the really important thing is not being just asleep at the wheel, but being adaptive and finding out where the pockets of relative strength are, and that's really what our system is meant to do.
Okay. And one of the things that's been carrying the market until recently has been the AI trade, and still the capex of the hyperscalers are spending is gargantuan, and it is propping even up the economy. It's a material part of the GDP growth. Um, there's, there's growing headlines coming into 2026 that we've talked about, but that we're saying like, maybe the AI trade isn't all it's been sold to be to us for a whole variety of reasons, right? It might be that the AI software is just not that good, or that companies aren't going to see the productivity boom that in an immediate enough time frame to justify valuations. We've seen the accusations of circular financing in this space. By the way, all that stuff is still continuing to go on here. And maybe all that's part of the reason for the capital rotation we've seen from growth to value. Um, but you know, a potential large risk here to the market, right, is that even though AI has softened now, and folks are thinking maybe it's oversold in the short term and capital come back, any one of those concerns that I just listed could actually prove to be true, or the market could start to believe them more. If the AI trade really broke down here, either because the capex spending slows down, or companies just decide the technology is not good enough, or uh, you know maybe regulators get in there and say, hey, look, all the circular financing is just funny stuff, and you guys need to stop doing that, whatever. That could be a pretty big downside risk to the market. At the same time, too, there's some more doomerish headlines around AI as well. So I guess just kind of give me a sense of how much you guys are monitoring what's happening AI right now, and whether on the net basis you're feeling bullish or bearish.
Yeah, so interesting. I wish I had it at my fingertips, but I saw a chart, and I'll try to dig it out and send it to you, Adam, in case you want to flash it up. But it was basically, I think it might have been Goldman, and it showed like they did an assessment of fourth quarter earnings calls and the percentage of companies that talked about AI as being an area that they were investing in and spending in. And then it furthermore parsed it down by those that are seeing revenue and those that were seeing profitability. And it's like, I forget what the actual numbers are, but a high percentage of companies mentioned it. And then when you got down to brass tacks in terms of actually demonstrating revenue, bottom line margin
Right.
revenue, it was like,
Incremental revenue. Yeah.
yeah, incremental revenue. It was like infinitesimally small on a relative basis. So we're still early stages, and it reminds me, if you go back, and again, I don't have this at my fingertips, but maybe I'll see if I can pull together. But if you look at the Fred database, for example, the Federal Reserve database, and you look at CapEx in information technology sector, what we saw in the tech bubble of 2000 was an explosion of that, right? The internet was being built, this revolutionary new thing that was going to change the world, and it did in many ways, right? But the capex spiked and then it crashed, right? It kept on going, but the pace was dramatically cut off. We very likely could be seeing something like that play out again. Spectrum, but I know personally I'm behind the times in terms of using these tools. I was out for dinner last night with a co-founders of a startup AI brain imaging technology company that I'm a passive investor in, and they are, seeing significant growth, but they're dealing with limited resources. They only have so much resources to build their sales, so they're actually using AI agents to help with the coding, and they're very much talking and these are professional computer developers, computer code developers. They are using these tools in a very, very applied way. That's not hype. It's absolutely changing the workflow of how things are done. And so I admit that I've got a lot of catch up to do personally in terms of understanding how these tools are going to adopt. And actually, Anthropic just put out a report. They're one of the two big private, Anthropic and OpenAI are the two behemoths, and they just put a report out yesterday. Take this for what it's worth, but it's a report called "Labor Marketplace Impacts of AI: A New Measure and Early Evidence." This is published on March 5th. Some key findings. There's some eye catchers here. So, for example, workers in the most exposed professions are more likely to be older, female, more educated, and higher paid. Well, that bullet alone is pretty eye-catching. But they did an interesting chart here that I'm just going to scroll down to that. This is their kind of assessment. I'll go a little bigger here. This shows different areas of commerce or the economy. And the blue bubble here is their estimate of the range of potential for AI in these sectors. So one thing is you can see different sectors like transportation, production, construction, agriculture. They don't see a huge, dramatically earth-shattering application there in terms of the potential. The red is what so far has been kind of achieved, if you will, or in sights of being achieved. So you can see there's a lot of gaps here between the red and the blue. And I think that absolutely will expand. I don't think it's hype. Again, this is just one entity's take on things. But I think the software sector. So we can fundamentalize about all this, but we ultimately take our cues from the market. And in the last month we've seen almost like a serial sell-off in different sectors. The software sector has been the most notable. Software stocks, many of them got pummeled 40, 50, 60%. These are companies that up until then were like thought to be, irreproachable. They had these moats that, they'd be able to collect their SaaS revenue fees forever, right? That's starting to be questioned. So software markets have sold off. So that's telling us the market is concerned about this. Probably a little bit overdone in the short term, but I wouldn't count it out. A neat little kind of parallel to that, I found this chart here. For those that saying that, I know I've seen some charts saying, the multiple in software sectors is cheaper than, for example, consumer staples on a forward PE basis. Well, that may be a couple of things. It may be that the software sell-off has gotten overdone, but it also might be that the super high multiples that have been applied and the earnings that have been assumed to be a birthright going forward for the software sector maybe are going to see some revisions downward. And here's I think a neat little kind of parable, if you will. And this is the newspaper sector. The dark blue line is the newspaper stock index, and the lighter blue line is the consensus forward earnings. So what you saw is the stock started selling off, even though the earnings estimates didn't really come down at all.
Yeah.
And it took a long, long time, a decade almost, for the earnings to actually catch down to where the stocks were. So it's just a parable of an example of, I wouldn't be so early to say that these, the sell-off in these software stocks is overdone in a dramatic way and that, hey, they're going to be fine just going forward. I think there is a repricing underway here that probably will take some time to sort out. Um, when you start with nosebleed valuations, not a lot has to go wrong to cause a re-rating downward, even if those companies are in fine shape. And maybe a good poster child for that is going back to the internet revolution. The Nvidia of the AI of the internet revolution was Cisco. Here's the Cisco price chart. It peaked up in 2000, way up here, crashed, I think, almost 90%. And it wasn't until now, 25 years later, essentially, that we eclipsed that 2000 peak. All the while, the revenue for Cisco was continuing to grow. The earnings per share was continuing to grow. That here was a little anomaly. They had some, charge-offs and write-offs there, but so the internet was everything and more than it was expected to be. But it didn't mean the investments, the prices that were being built into the valuations of those companies, those leading innovative companies that continue to grow, were good investments. And that's the caution I would put out as relates to these AI hyperscalers. They're not going to shut down overnight. They're probably going to keep growing pretty dramatically, but it doesn't mean the share prices keep going the way they have.
So what I want to do is I want to tie this to a conversation I just had with David Rosenberg, which was just posted here on the channel, was, trying to say like, okay, so um, uh, what's going to matter going forward, and with things like AI, there's threats of job displacement and all sorts of things like that, and uh, we talked a bit about the K-shaped economy and the fact that the bottom leg of the K is continuing to struggle and might still have more struggles ahead of it. Um, but David kept coming back to the fact that uh, the thing that's going to matter at the end of the day to the economy is it's going to be the stock market. It's going to be what happens with the stock market. Uh, it's almost, and he didn't mean to be dismissive, but it's almost immaterial to what happens with the bottom half of the K, the bottom leg of the K, because the spending that the top leg of the K is doing, um, it dramatically outweighs the purchasing of the bottom half of the K. And so as long as asset prices are going up, the top half of the K, the affluent folks, are going to keep spending and probably keeping the averages looking pretty good. So what matters at the end of the day is going to be what happens with the stock market. Because if the stock market falters, or even in David's perspective, just goes sideways, um, that's going to start causing the affluent cohort to start tightening its belt, and that is what's going to lead to the notable reduction in consumer spending. That's then going to impact earnings. That's then going to impact stock prices, and that negative wealth effect would eventually be what drives the economy to slow down. So we're kind of in this world where like everything hinges around where the stock market is going. And you were talking about valuations, John. We talk about this a lot. They're still pretty much near all-time extremes, and it's not a good timing mechanism. But whether it's disappointment in AI, whether it's in the Iran war goes metastasizes and goes way worse than we think. Maybe it's oil prices stay a lot higher here, and that starts impacting profit margins. Whatever, there just seem to be a lot of potential pins that could uh, you know cause some sort of downward repricing in the stock market. And if that were to be the case, that would be the big thing that would take everything else down with it. So I'm just curious, Mike, probably an unfair question, but um, as you guys look out to the rest of the year, how concerned are you about some event like this that could take this, create a material enough stock market correction that we start to get that cascade that I just talked about?
Oh, we're hugely concerned about that, Adam. I mean, we're always wondering, is this the big one? Because we're expecting a big one. If you go back to that chart that we showed there that John Hussman put together in December, we're literally like 3x overvalued versus long-term norms. And we have been for over 20 years. That's the whole thing. we really can't ever get back to norms again, or the whole debt pile blows up. So we've embarked on this whole scheme of printed money for so long, but certainly since the great financial crisis. What that's caused after all these years is a K-shaped economy, like you talked about. The wealthy are so wealthy they could lose a third to a half of what they've got, and they would still do okay. They would still, at least for a while, be able to fuel the economy. The bottom half will get pretty darn ticked off because they didn't really take the ride up. Now it's we don't know if they're going to get ticked off right away, but eventually, if in general it becomes known that the focus of the wealth effect caused a misery in the future that didn't otherwise have to happen, I think a lot of people are going to be ticked off. But to your point about the fact that the economy is the market and the market is the economy is somewhat true in the long term, but it doesn't have to be true at all in the short term. I mean, I think there's already some weakening data. I don't have the data in front of me, but very recently there was a surprise negative GDP. I think, the prior quarter showed annual GDP at somewhere around 4%, and the release that just came out recently was like 1.4 or something like that. So it was a downside surprise. We don't know if that's really anything other than noise right now. We're hearing about layoffs. The SOM indicator tripped, I think, over a year ago now, and that's when unemployment starts to curve upwards. That has previously predicted 100% of recessions, not this time. So, and now AI, there's all this talk about these layoffs at companies like, I think it was Square last week or something that laid off 30 or
No,
40% of the
Block.
workforce. Oh, it's
Yeah,
Block. That's what it
Block.
was. Yeah.
They laid off 50% of their workforce, claiming that they just don't need them because AI is making them so much more productive. I will put an asterisk next to that and say, though, Block had on a relative basis, a very bloated headcount versus other companies in its industry. So
Makes
this
sense.
could have just been a little bit of a smokescreen for just getting rid of people. But yes, it got rid of half of its workforce.
And we'll see. I mean, we're forced to guess a little bit or to speculate sometimes about what's going to happen next because the truth is none of us know. We know that we're severely overvalued. We've dialed down our equity exposure because of that. We know that short-term our indicators have flipped red. We've added a little bit of index put option, a little bit of insurance because of that. But as we were showing these charts earlier with these triangles and only being 3% off the high, I wouldn't be surprised if we squeeze the new highs and have a bit of a blow off top. In fact, it feels like that's what's going to happen to finally cause this thing to end. And we could absolutely have a big up market while we're in a negative economic environment. In fact, we could already be in a recession and we could easily have a blow off top of the market over the next few months. So those things could happen. And that's the thing about investing is that anything can happen and you're going to have to be ready for it. So I believe that we're in a fourth turning. We talk a lot about that, the fourth turning, and I think we're in the last few years of it. It's not surprising that we've seen everything thrown at this issue to try to keep the economy and the market up, really the market up so that the economy stays up. The price of everything has to keep going up. It's been unfair. It's probably long in the tooth. We probably have a few years left in this fourth turning. And the exact path of how this thing ends and changes, it's what nobody knows. And it drives people crazy trying to figure it out. Our system doesn't have to know what happens next. Even though I think there's a probability we get a blow off top, we're not trading from that perspective. So I would just say be careful out there. We're at rarefied times. Valuations have never been more extreme. Like that John Hussman chart I put out there, it hasn't mattered and it doesn't matter, won't matter till it matters. And it hasn't mattered for almost 10 years. But those times are likely ending fairly soon.
Okay. I don't like asking the question this way, but um, uh, valuations are poor timing metrics, and many financial advisors still live by the words of Chuck Prinz, which didn't work out too well for him. But he said, look, sure, maybe there are reasons to be concerned, but right now the music's still playing, and when the music's playing, you got to be on the dance floor dancing. How do you guys balance the trading the market you have, right? And therefore kind of dancing while the music's still playing, versus having an eye towards that just sort of fundamental concern that you voiced there, Mike, of like not trusting the long-term prospects of this market, being worried about the lost decade. So how do you kind of, balance getting returns in the here and now for your clients while not, trying to reduce their vulnerability to some sort of secular big downwards market change?
Adam, you have to be willing to give something up, in my opinion. Right now, we're set at around 47 or 47.5% equity. And I just said that I think we could get a squeeze or a blow off top higher. That blow off top could easily add 10 or 20% in a short period of time. You could see something like the S&P go from close to 7,000 to maybe 8,000, 8,500. If that happens, we'll underperform a little bit, I believe, because we're set at 47% equity. You have to be okay with that over the short term because you've got to make a biased or you got to make a call with a bias about the big picture being hyper overvalued. That's been painful to be early, and we've certainly been early over the last 10 years at different times. It's been a pretty humbling experience sometimes, just how extreme things could get and did get. And not only that, how extreme they stayed. So, but I would say to answer your question, you set your risk allocation. You've got to accept the fact that you could underperform in a vertical move higher. And furthermore, you're gonna have to accept that you give a little bit back on the downside. So we're at 47%. The first thing we're going to start to do if we see a downside follow through or a crash is start to perhaps take some stops in our sectors. We're in the strongest sectors. And so our technical tools have been very kind to us over the last 6 months and certainly year to date, in that the exposure that we have has been doing really well. Utilities, industrials, healthcare has been doing pretty good. The sectors that we're in have been doing really well, and hopefully they'll continue to outperform the market, and that'll take away some of the underperformance gap. And hopefully they'll also outperform if the bottom falls out of the market. But that's how you do it. And we have an overlay, a fundamental overlay, with, as I know you know, and your viewers know, gold, silver, and miners. That's been really helpful too, to help create, some performance. We had a really good year last year. We're having a really good year so far this year, but nothing's perfect. And so I tell people when we talk to them, probably one of the risks or one thing they should be aware of if they work with us is that we don't attempt to get every little bit of upside, particularly in a vertical market. Furthermore, I've got to tell them that the downside is not zero, that it's impossible to be zero, but we should be exposed to much less than the market. For instance, back last April when we had I guess it was April 1st, the Trump tariffs, the S&P was down something like 22%. We were down maybe 4% peak to trough on average, just to give an idea. There's always some type of give back. And it's a very hands-on tactical strategy, one that we think will continue to outperform, particularly on the downside, if we get the type of downside that we think we're going to get. And we think that's very likely as we head through this year. And we think it's very likely as we come out of this 20 years of just mindless robot type buying. I think the mindless robot, as we talked about earlier, as one of your guests talks about all the time, is likely going to be a risk to the downside as well. But we'll just take the data as it comes, and that's how we'll react, taking stops, have some index puts kick in if we get some type of crash. We will be reducing equity exposure in a big downside move where all the passive managers will just be talking to their clients, telling them to never sell, always stay invested. So we're going to be the opposite of that.
And Adam, I'll just add, what you're really talking about there is even despite these extreme valuations, we're not always playing defense. We're doing different shades of offense, and we have a broad-based battery of indicators that help us kind of gauge the trends and the momentum of the markets. We look at things like various moving averages. We look at momentum. We look at participation indicators like bullish percents. I realize I'm throwing a lot of technical jargon here, and suffice to say, we've got a weight of the evidence dashboard that we look at to help us gauge those probabilities. Does it make more sense to be playing offense right now, or does it make more sense to be playing defense? And if so, what specific plays make sense to play in that environment? And one big element of this, even is when we're underweight equities, we want to be where we do have exposure. We want it to be in those sectors that are carrying more than their full weight in terms of the market performance.
All right. Well said, John. And we're at the point where we got to wrap up here for time wise, but let me give you the last main question here, which is, Mike said that you guys have had a couple of good years. Your approach has been working well for the markets that we've had. Um, and I know just from the data, you guys have had a lot of leads come from thoughtful money viewers to want to come talk with you guys about a variety of things. And you've taken on a lot of new clients of late. And to me, that shows that the general investor is starting to wake up to this dynamic that we talked about earlier, that the easy sort of passive money, those days might be ending, if not over. And an active approach might be, very well maybe the right way to go. And I think a lot of people are saying, hey, look, I got a real job, I got a real life. I don't really have the skill set, the desire, perhaps, to do that kind of active investing. So I want to find an expert who can do that for me. So just tell me real quick, what are you hearing from a lot of your prospects and accounts right now? Like, what's the average investor, at least from Thoughtful Money, what's weighing heavily on their minds right now? And what are the kinds of things that you're helping people with right now, given the dynamics of the current market?
Yeah, well, we're fortunate to be able to talk to a lot of folks. Some of them become clients, some don't. But every conversation we have, we hope to impart some value and perspective to those conversations. But a common thread that we come across with folks that reach out to us is it could be a well-informed or just a gut instinct that they have that markets aren't quite as sanguine as the cliches dispensed by Wall Street would have you believe. There's the ever present, don't try to time the market admonishment by Wall Street machine. In fact, essentially they're telling you to never sell, right? Which is we think is quite lazy, frankly. And especially clients like many of the folks that we work with and prospects they've done a very good job at building through sacrifice and hard work a very sound financial picture. And their biggest risk is not missing out on a couple percentage points in a late stage, highly overvalued market. Their biggest risk is suffering. They may not realize this, but mathematically, this is the case, suffering a big decline that they've then got to dig out of. There are lost decades. We know this from history. And it's not just a nice thing on a chart. It is a painful experience for someone that has done a good job and built a foundation to witness that and suffer that. Maybe it adds another 10 or 15 years of working life to their picture. This is real serious stuff. A lot is at stake, and it's not crazy to think about reducing risk. Even if you're younger, there's so many cliches in our industry and Wall Street that, all you need to do to get higher returns is take more risk. That is false. That implies this coin flip phenomenon in markets that is weighted to the market always going higher versus going lower. That is just BS, frankly. There are times in the market cycle where that coin is not an even flip. It is probabilistically and objectively more likely to land on tails than heads. And that's really where, a disciplined approach can come in and, keep in check the fear of missing out and really focus on the right kinds of fears. And that's, very significant and oftentimes permanent capital destruction for those that don't have the ability to kind of dig back out. So that's what we're hearing. It's not stick your head in the sand. It's not a put your money under the mattress, but it's taking prudent steps to manage risk and be tactical in a market that's very challenging and very extremely overvalued in our opinion.
All right. Well, very well said, John. And look, folks, if you're a viewer and you're having some of these concerns, as I imagine a lot of people are who either are already retired or approaching retirement, say, wow, if there does indeed happen to be a lost decade lying ahead of me where I can't really count on the market to do the heavy lifting I was counting on it doing in terms of appreciating my capital as I enter my retirement phase, what the heck do I do about that? Feel free to have a conversation here with the guys at New Harbor, and I'll tell you how to do that in just a second. And as John and Mike have very kindly always said, they're going to talk to you no matter what. If it turns out that the fit's not good or you decide not to become a client with them, they don't mind. They're just doing this to help as many people as they can. All right, Mike, I I realized there was one thing you mentioned to me before we turned on the camera here that I'll let you talk about literally just for a couple seconds. I'll give you plenty of time to talk about it next week when you guys are on the channel again. But I think you said that that Bitcoin might be having a technical breakout here to the upside.
Yeah, let me share the chart here, Adam. It's a bottom fish breakout to be fair. We haven't been in Bitcoin for a while, and we're still not in Bitcoin now. But what we have been looking for is some kind of trigger, some kind of bottom fish trigger. And I will say that Bitcoin had a pretty big decline, faster and deeper than I would have expected. And yes, Bitcoin has had a history of 70 or 80% declines many times, but in my opinion, Bitcoin has somewhat proven itself, at least from a technical perspective and from an institutional acceptance perspective over the last couple of years. So, obviously with this big 50% drop, we're looking at it and just kind of wondering if there's some opportunity there. So let's just take a look at the point and figure chart, the type of chart that we often use to take out some of the noise of short-term movements. The all-time high of Bitcoin was right up here last year at 126,000. And so it came down, broke through 100, and very quickly went to like 81. And so this little move here from 81,000, you can see that over here up to about 97, looked like the market was bottoming. This is a bear flag, and I actually thought the bear flag was a little too obvious at the time. Personally, I thought we were likely to go back up and hit new highs and maybe go to 150 over the next year or so. So this failure was certainly a surprise. I think a surprise to the market, and it caused a lot of pain and misery in Bitcoin land. And so a bear flag. Look at this little breakout out of this bear flag. So that was pretty painful. That's called a bull trap, or I guess it's a bull trap. Yeah, because people would have bought that breakout and then look at that drop there from 97,000 to 59,000. Pretty crazy. Well, here we have again a triangle and a breakout, right? So a breakout, is this going to be yet again another trap? Or is this a good bottom fish play? I just want to call out that's something that we're keeping an eye on. We're not acting on it just yet. But here with the market losing, or the Bitcoin losing 50%, having a second breakout, basically a bear flag breakout, because the bear flag means that the trend is down beforehand, and then normally you'd expect it to break down. I don't know if this is a fake out. I'm just putting it out there that we're watching it closely and that it could be for those that wanted to have a position that never have had one, nibble a little bit. I don't think that people have to be in crypto at all, particularly those that are in gold and silver. I think that you don't have to be in both, but this is probably the first time in a while that it looks like there could be a lower risk entry.
All right, so potential bottom fishing opportunity, time will tell. And if you get to a point where you feel like, hey, yeah, I really think that's the case, and this is a good entry point, obviously you can mention it on your weekly appearances here. Okay,
Okay.
so folks, as a reminder, this is I don't want to say this is a new thing that we're doing, but it is becoming a regular thing that we're doing, having the New Harbor team come on monthly and giving them a full episode to just be able to give their full overview. Something I very much value. I think today was a great discussion, but if you'd like these to continue, just let us know both in the comment section below, but by hitting that like button, and if you haven't already, click the subscribe button below, as well as that little bell icon right next to it. Obviously, if you want to talk to the guys here at New Harbor or at any of the financial advisors that Thoughtful Money endorses, you can do that at any time, totally free. All you do is just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds. Again, these discussions don't cost anything. There's no commitments involved. It's just a service these firms offer to help as many investors as they can. One last thing too, if you are watching this video the day that it airs, which is Sunday, then you have less than 24 hours to lock in the lowest price early bird discount that we're offering to the Thoughtful Money Spring online conference. So if you haven't bought your ticket yet, you should go absolutely right now, this second, to thoughtfulmoney.com/conference and buy your ticket so that you can lock in that lowest price. I want as many people as possible to get the lowest price possible. Also, if you are a premium subscriber to our Substack, check your email. You have a code from me that you can use to get an additional $50 off of that lowest early bird price discount. And a reminder that the spring conference itself is happening on Saturday, March 21st, which is coming up real fast. If you can't watch live that day, don't worry. Everybody who buys a ticket will be sent replay videos of the full event, all the presentations, all the live Q&A, and you'll get those replay videos within just a couple hours of the conference's conclusion. It's going to be a phenomenal conference. Real quick, it's going to be really our best faculty ever. Lacey Hunt will be doing his traditional kickoff with his graduate level parade of incredible charts. We'll have first-timers Ed Dowd and Michael Oliver there. We'll have journalist Matt Taibbi. We'll have Luke Roman and Brent Johnson. We'll have Judy Shelton and Danielle DiMartino Booth. We'll have Michael Howell and Darius Dale. We'll have Stephanie Pomboy and Grant Williams. We'll have Rick Rule and Lynn Alden. We'll have David Hay and Andy Sheckman. We'll have Melody Wright. There's maybe one or two others I'm forgetting, but as you can tell, folks, it's just an amazing assortment of talent. And again, to watch it all, just go buy your ticket at thoughtfulmoney.com/conference. And obviously, John and Mike will be joining in the day as well, as they always do. Gentlemen, thanks in advance again for joining us for the conference. But thank you again for a great recap and everything that you've processed for us in the past hour here. And just overall, too, in terms of your guys' general partnership and friendship. You guys have been absolute wonderful partners over the past 15 plus years now at this point. I can't believe it's been that long. But again, thank you from the bottom of my heart for just the number of viewers of this channel that you guys have helped in one way, shape, or form over that time.
Time flies, doesn't it, Adam? It's pretty crazy.
It really does.
But we're grateful too. Grateful for our relationship and our friendship. And we always love the conferences. And we'll be sure to be there and answer questions from the viewers. And happy to be here this week. Thank you.
I'll just add my thanks, Adam, and it's a great privilege to be able to do what we do for clients, and a great privilege to meet so many of your viewing audience. And even if it's just a half-hour conversation, we rarely leave those conversations without feeling good about the conversation we just had, and we're thankful for that.
All right, gentlemen, thanks so much. And you know, we started this off by joking that there really wasn't much that had happened. Of course, there's so much going on here that's likely to continue in the near term. So look forward to having you guys back on next week to make sense of that for us. Thanks again for everything, and everybody else, thanks so much for watching.
I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they can be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Gold hit a more than 4-month high on Monday, as increased bets for a U.S. Federal Reserve interest rate cut this month lifted bullion's allure, while silver rose above $40 per ounce for the first time in more than a decade. Peter Schiff expects a strong move higher, possibly as early as Tuesday, and advises buying silver now before prices jump, since ETF buyers might face much higher levels. The same goes for gold. If it gaps above $3,500, that would be a significant $50 move, supported by both strong fundamentals and technical momentum that could trigger a breakout. Peter Schiff, an American stockbroker, financial commentator, and author, highlights that gold appears to be entering its next big rally, likely beginning when it broke above prior highs on Friday, setting the stage for a quick move toward $3,500. As of early Asian trading on Sunday, it was around $3,448 after briefly topping $3,450. Silver also hit a 13-year high Friday, closing just shy of $40, and is now trading near $39.72. Both metals look technically and fundamentally strong, helped by a weaker dollar index, which closed below 98. The U.S. bank holiday is contributing to thinner liquidity, which is also exacerbating some of the moves in gold and silver. Silver is making a move higher in response to expectations of lower U.S. rates, while a tight supply market is helping to maintain an upward bias. Peter Schiff recalls predicting a golden age for gold during Trump's presidency, noting that while Bitcoin is being promoted as digital gold, it has underperformed, trading below its prior peak despite hype, ETFs, and official support. Gold, by contrast, is hitting record highs, far outpacing Bitcoin and stocks. They warn that Bitcoin looks like a pump and dump scheme and suggest converting it into gold or silver instead. Let's dive into Schiff's video for more insights. If you find the content engaging, please consider giving us a positive review and subscribing to our channel to receive the latest updates.
Gold, I think, is finally getting ready for the next leg up. In fact, it probably started that leg up on Friday by going through the highs. But now I think we've got clear sailing to get up to 3,500. I think we'll pass that relatively quickly. In fact, I'll take a look at where we're trading right now. Early Sunday evening, so Asian trading is just kind of kicked off. And in the gold market, let me pull that up. Yeah, no, gold's down about 90 cents, 3,448. A few minutes ago, it was trading above 34.50. Silver also on Friday. Silver closed at a 13-year high. We came within 10 cents of $40. Right now, we're trading at 39.72, which is up about a dime from where we closed on Friday. But both gold and silver looking very strong, technically, fundamentally. The dollar was also weak on the week. Dollar index closed back below 98, about 97.80. So weakness in the dollar also working to help the gold market. But I think there are major, fundamental stories that are going to be fueling this gold market rally. I said it on this podcast when Donald Trump gave his first speech as president and announced the golden age in America. I said he's right in a literal sense. It was going to be a golden age for gold. And so far, gold is off to its best start probably of any presidency in history. Trump may not be making America great again, but he's making gold great again, not by intention, but the unintended consequence of his policies, right? He's trying to tout Bitcoin. Bitcoin is only up about 14% on the year, right? Gold is killing it. In fact, Bitcoin is 13% below its peak, right? Clearly, it's not digital gold. Gold's making a new record high. Bitcoin's in a correction. It could easily enter a new bear market pretty soon. And of course, the stock market is, gold stocks are crushing the returns in Bitcoin. But Bitcoin is still today about 13% lower than it was at its peak 4 years ago if you price it in gold. So despite all the hype, all the Bitcoin ETFs, the Bitcoin treasury companies, the strategic Bitcoin reserve, America being the Bitcoin capital of the world with the first Bitcoin president, Bitcoin is still lower than it was before any of that stuff happened. So how is that possible? How can all this good news and all this new buying not drive the price higher? Because there's a lot of people smarter than the people who are buying who have been selling into all the hype. This is a gigantic pump and dump that's going on with Bitcoin. And the big pumpers now are the Trump administration, and all of their friends are the dumpers. But if you're smart, you'll get rid of what Bitcoin you have, and you'll go down to Shift Gold, where we work with BitPay, and you'll take your Bitcoin and you'll buy some gold or you'll buy some silver. This is a holiday weekend, so the U.S. markets are closed on Monday. I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they could be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Peter recalls how mainstream financial media often ignored gold, even when it was making major moves. He remembers being on CNBC years ago when gold had risen about $40. To him, that attitude showed a lack of understanding, because gold isn't just a commodity, it's money. Historically, even Alan Greenspan used gold as a key measure of monetary policy, warning that high prices signaled excessive looseness. Today, with gold around $3,450, it's clear that monetary policy has been far too loose for decades. Central banks themselves treat gold as the most important asset, stockpiling it while shunning other commodities. Rising gold prices, Peter Schiff argues, are a warning sign of deep economic problems in America, yet many still dismiss it while hyping Bitcoin instead. He stresses that central banks, the insiders of the fiat system, are effectively dumping dollars in favor of gold, signaling a loss of confidence in paper money. Investors should follow their lead by shifting into gold, silver, and international value stocks, which are already seeing strong returns as money flows out of U.S. assets. Now let's dive into the interview.
They barely talked about gold, as gold was making all-time record highs. You know, I still remember when I went on CNBC back when they still had me on. I hadn't been on like 10 years. I don't know. I can't remember when I was on. But when I used to be on every week, but when I first started going on, I was on Squawk Box, and the host was this guy, Mark Haynes, who passed away quite some time ago now. But the first time I was on, of course, I discussed the price of gold, and I think it was still below 300, or maybe it was in the low 300s. I forget. But I came back, I don't know, a few weeks later, and I'm in the studio again talking to Mark Haynes. And I said, Mark, gold's up about $40 since the last time I was in this studio. And his response to me was, who cares? Who cares about the price of gold? And, he mentioned a number of things where he cares about the price. But he says, I forget, maybe it was bread or oil, I forget. But he said, why should I care about the price of gold? Right? He is the anchor in a financial news show. It's supposed to be focusing on finance, investing, economics. And he says, who cares about the price of gold? I mean, how could you not care about the price of gold? Only if you just don't understand what gold is. I mean, gold is money. It's you're a show about money. How could you not care about gold? And when the price of gold is going up, especially like this, it is a warning. It is telling you that there's a problem, right? I mean, even Alan Greenspan, I talked about this, he used to use gold as his primary reference to know whether or not he was too loose or too tight. He used to say that if gold gets up near 400, I'm too loose. If it goes below 300, I'm too tight. Now, what does that say? Look where we are now, 34.50. We've been too loose for decades based on Greenspan's metric. But the gold is the most important price. It's not just a precious metal. It's not just a commodity. It's a monetary metal. Central banks are holding gold for a reason, right? How could you say, oh, I don't care about the price of gold? Well, what about all these central banks that are hoarding all this gold? Don't you think that's significant? Because, they're not stockpiling other commodities. They're owning gold for a reason. It is the single most important price out there. And right now it is screaming that there is a huge problem. There is something rotten in the state of America. And that's what you're seeing in the gold market. And, I'm sure that mentality still exists today. The same one that Mark Haynes had, even though he's not around anymore. I think that idea that who cares about the price of gold, right? What's the big deal? It's nothing, right? It's just a rock, right? They care a lot more about Bitcoin than they do about gold. But if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system, right? So if you see in a company, if all the managers are dumping their shares, they might know something that you don't. Well, this is basically what's happening. The managers of the fiat monetary system are dumping their dollars. They want out. And they're buying gold. They're not buying other currencies. They don't want another fiat currency. They want real money. You should do the same thing. And the same thing is happening with investors, not necessarily in gold, but they're dumping their U.S. shares and they're buying back their own stock, right? That's why, you know, my dividend payers fund is almost up 40% on the year now. It's at 39%. It's on the high of the year because value international dividend paying stocks, that's where people are putting their money now. That's where when they sell in their U.S. stocks and they sell their dollars, they're bringing their money home and they're buying value. They're buying income, right? They're buying these dividend-paying stocks. I think we're still early in this trend.
Gold and silver are showing clear signs of entering powerful new rallies, with central banks and investors driving demand while the dollar weakens. Peter Schiff emphasizes that gold's record highs are not just a market trend but a warning of deeper economic issues tied to excessive money printing and debt. He argues that unlike Bitcoin, which he views as speculative hype, gold and silver remain true stores of value and the assets central banks themselves trust. For investors, the message is clear: follow the smart money into precious metals before the next breakout accelerates. Do you think gold's rally toward $3,500 will trigger broader recognition of it as the ultimate safe haven? With silver nearing $40, could this be the start of a long-awaited move into triple-digit prices? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
In 2025, Arcadia Economics' Chris Marcus notes the silver market faces structural shifts amid rising deficits. Silver has surged 88% since early 2024, climbing above $40 for only the third time in history, according to a report by Arcadia Economics. Industrial demand reached a record 680.5 million ounces in 2024, while retail selling and supply constraints highlight growing imbalances. Institutional flows, new technologies such as Samsung's silver-heavy batteries, and fresh central bank interest in Russia, coming from Russia, Saudi Arabia, and the U.S. I wouldn't say that we're central bank buying yet, but central authorities are buying silver now. We're going to be hoarding silver now. They all suggest silver's strategic role is expanding rapidly.
As deficits widen, significant structural shifts in the silver market have been noted. Silver has risen 88% since the beginning of 2024 and is now above $40 for just the third time. In 2024, industrial utilization reached a record 680.5 million ounces, propelled by innovations such as Samsung's silver-rich batteries. Although there are obvious mismatches in retail sales and supply, institutional inflows and escalating interest from Russian, Saudi, and American authorities indicate that silver's strategic significance is rapidly increasing. Vince Lancy, a veteran trader, metals analyst, and founder of Echo Bay Partners, highlights an extensive analysis of silver's prospects for 2025 published by Chris Marcus of Arcadia Economics, highlighting the metal's significance for years to come. Samsung's silver-heavy batteries are a major emphasis. The estimated demand for silver is so high that a logarithmic chart is needed to explain it. Marcus's enthusiasm and thorough analysis are evident in the report, which is a great tool for anyone interested in silver. The focus is now on Trump's new Executive Order 232, which raises concerns about the future of policy because it noticeably ignored silver despite previous references. Powell has essentially deprioritized rigorous inflation targeting, so rate cuts are more dependent on job losses than inflation, even though upcoming data like the CPI and PPI may influence markets. As we begin the video, don't forget to hit the bell button and subscribe so you don't miss any updates. Please leave a comment below and give us a thumbs up if you found the article interesting. We appreciate your feedback.
Silver's future looks very bright, as well as the unlock post, which is linked in there for Chris Marcus's Arcadia Economics. So, personal professional comment now. Chris Marcus published a mammoth, ambitious report this weekend on silver's outlook for the rest of 2025. While the report covers that time frame, makes it like a timepiece, its implications extend far beyond that, making this a must-read for anyone who wants to understand the likely path of silver ahead. One section worth highlighting is on the Samsung batteries. Now, we had read this and we know about this, but we had never looked at the side-by-side how much silver was used, how much silver could be used. We even tried to create a graphic for it, but couldn't make it fit. That's how earth-shatteringly large silver's role would be in these new batteries. We put the graphic in. The first graphic was, this is how much silver is used versus this is how much silver will be used. And it was ridiculous. So I had to make a log normal chart. And even then, it's ridiculous. Anyway, Chris was kind enough in the credits to thank me for my contributions. And I'm glad to have played even a small role in what is clearly a labor of love. If you know Chris, you know his passion for silver, combine that passion with detailed industrial analysis, and the result is pretty impressive. The full report is included in the post, and we would recommend you visit Arcadia to take a look at that as well. Moving on. Related post, HeartNet, we mentioned that. Sunday CFTC analysis, that was a really good one. It was a fun one for me too. I got 2 hours of that recorded, and very lively interaction, as well as some good questions. And plus the guys got me to talk more about my childhood trading. Mini pod, macro discretionary, Goldman, gold price near 5,000 and Fed damage. It's starting to look more realistic to me than it sounds. Coming soon tomorrow, probably, we're going to have a breakdown and analysis of Trump's executive order 232 signed this weekend. We have a couple calls into people that we're trying to get some more information back on. We understand the implications for gold. People have been talking about it. We actually have some analysis from a Goldman trading desk, institutional stuff, that'll break down the gold for us. We're going to look at that a little bit closer today. And what we're focusing on now is getting data on what was not said about silver. Silver was not mentioned. And you could say, oh, well, it's just, who cares, right? No, silver was mentioned when 232 was first discussed, but it wasn't mentioned in the signing of the executive order. So what does that tell you? I don't know. We're going to find out. Data on deck, CPI and PPI. Now, those are important numbers. They're always important numbers, and they're going to move the market. But I'm telling you, they're not important unless they're incredibly high for Powell's decision to cut. Okay? The decision to cut is based on the economics. Are we firing people or not? Not the inflation. He has already raised the inflation target by abandoning the FAIT. He has basically said, I can't focus on inflation anymore. He blamed it on the FAIT, tied it to the goat, released it into the desert. The scapegoat is out there. It's done.
Vince Lancy clarifies that unless inflation is exceptionally high, Powell's rate cut plans are unaffected by short-term movements in gold based on CPI or PPI data. Intraday charts and stringent risk management, setting tight stops, taking partial profits, and letting the remainder run if momentum holds, are their main tools for trading. At the moment, silver provides little clarity but may be creating a bull flag, while gold appears bullish above critical levels. Instead of chasing moves, the emphasis is on risk management and discipline. Let's dive into the interview.
Because look, if you see gold drop $100 on CPI or PPI, check in. Why? It's not going to change his plans unless it's ridiculously high. All right, let's move to the markets. As I said, you don't want to buy gold now because of this symbol. If you're buying gold, you're buying it for a completely different reason. Okay. And I'll tell you what the reason is for me. The reason is I'll take this analysis, this system that I use, and I'll break it into an hourly chart. And I'll say my bias is bullish because of this chart. And then I'll put it into an hourly chart and I'll look for an entry point that tells me acceleration is due. That's the weekly in gold, the weekly in silver. Weekly in silver's marching along. The daily in silver really was the cue there. Let me go to a couple other systems. Okay, so I'm doing my intraday analysis right now, right here for you. There's an algo buying the market. It's not safe to buy it below 36.13 for the next 2 hours. So I'm long. I'm not buying it right now, but I'm long right here, and I'll sell it on a stop loss below 36.13. And how much am I risking? $5. I'll sell it at 36.28. That's it. Risk 5 to make 10. Go with the flow. Stop yourself out and move on. Now, if the market gets down here and breaks this, I back off. I reset. As long as it's above these lines, that's poly market, by the way. Poly trends, not poly market. Poly market's the gambling site. I think these lines are pretty important for the day. And even if they weren't here, I'll take it out so you can see it a little bit more visually. This is a line going. This is a typical line that I would draw. I was like, all right, this is where it paused. This is where it got rejected. This is where it broke through. As long as it holds in this area here, 35.98 area, then I would look for another reason to get long. If it breaks 35.98, I start looking for reasons to get short. Intraday. Okay. So if this never breaks, so I just bought it right here, right? In our hypothetical, I bought it right here. And I don't get stopped at and it goes to 35.28. Should I take my profits at 36.20, 36.28? Well, yes, I risked one to make two, right? No, I'm not going to do that today because I'm already very bias bullish. I'll sell half. I'll let the half run for the rest of the day, for the rest of the week, for the rest of the month if I have to. And that's the idea. You get a good entry, you put a tight stop in, and you trail your stop higher. That's the way to look at it. Let's see what silver offers. It's not rocket science. It's just being disciplined with your risk. Silver offers me no insight right now. No insight, at least on these things that I look at. Let's see what Poly has. I'm doing this for the chat, guys. I know you guys are very looking at this very much. All right, so Poly gives us a level to not be bullish above for the rest of the day. 41.18, which is pretty close. So no Bollinger Band analysis here. You ready? You buy it here with 41.18 as your stop. If it goes below 41.18, you're neutral. If it goes below 40.91, you're bearish. The rest of the day, intraday stuff. This doesn't affect my silver physical. Doesn't affect anything. I'm just trading. How's the movie go? It's just money, right? And silver's not just money. Silver Daily, that's great. All right, so this is shaping up like I can't believe I'm saying this. This is shaping up like a bull flag.
Silver's role as a strategic asset is rapidly expanding, supported by record industrial demand, new technologies, and growing institutional interest, even as policy signals remain uncertain. Gold continues to show strength, while silver may be setting up for its next move. For investors, the key lies not in chasing short-term swings but in understanding the bigger structural shifts and managing risk with discipline. How might Trump's Executive Order 232 affect silver's future role if it continues to be excluded from policy discussions? Could Samsung's silver-heavy battery technology accelerate silver shortages faster than markets expect? We would love to hear your opinions, so please leave a comment below. Please remember to subscribe for more material, and give this video a thumbs up if you found it helpful. We appreciate you joining us on this adventure.
I think gold is going much, much higher.
Yep.
I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I don't disagree with that. And
But
as
you
I
said
just
gold
said,
was
$35,000 per ounce. I mean, that's the highest number we have heard on gold today, right? That's my target. But what I'm saying is that does not
It is
rule out
not
a
a bubble.
40% decline into a deflationary bust where the Dixie can go to 122.
Fair
You
enough.
can't
Fair
expect
enough.
rate cuts without some aggressive buying of the bond market. Who's going to rush in and buy all the US issued bonds in an aggressive way that it pushes prices up immensely, sufficiently for you to have that dip in rates that's going to lead to a 40% correction in gold?
The speaker, Henrik Seeberg, along with Francis Hunt, projects gold soaring to around $35,000 by the early 2030s, calling it their long-term target, yet warns this doesn't rule out a sharp correction along the way. They caution that a deflationary bust, driven by a surging dollar index possibly reaching 122, could trigger as much as a 40% decline in gold before the next leg higher. With current rate cut expectations and without massive, aggressive bond buying to push yields lower, they question who will step in to absorb U.S. debt, suggesting that such market stress could create the conditions for gold's temporary collapse before its eventual climb to historic highs. Francis Hunt, the market sniper, in discussion with Henrik Seeberg and Matthew Piepenburg, noted that while some foresee a 30 to 40% correction in gold during the next crisis, such a dip would be a buying opportunity. They argue a deep collapse is unlikely since today's rally is fueled by central banks like China and Russia, not just retail investors. Even a 15 to 20% drop would likely see these nations selling treasuries to buy more gold. Still, Henrik and Matthew caution that a strong dollar spike could trigger a meaningful pullback in a deflationary bust. Henrik Seeberg, a macroeconomist, trader, and financial strategist, countered that forced selling could still drive gold lower, whether from hedge funds in trouble, leveraged retail traders, or even stressed sovereigns liquidating reserves. Matthew Piepenburg, macro strategist, author, and investor, highlights that in such moments, liquidity needs dominate, and because debt is denominated in dollars, gold often gets sold to raise cash quickly, just as in 2008. Yet unlike that crisis, today's backdrop is very different. Central banks, the BIS, and even discussions in the U.S. point to gold's growing role in the financial system, with BRICS nations using it for settlement in trade and oil deals. This stronger structural demand suggests that while short-term volatility and corrections may occur, the long-term trajectory for gold remains firmly upward. We're about to explore the video, but first, subscribe and hit the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
What Henrik is saying is valid. For me, again, I'm still agnostic because I started buying gold 20 years ago. If we have a 40, 30% dip in the next market crisis, I'm relatively using that as a buying opportunity. But smugly,
But hold on, you have the notion that we'd have a 40% drop in gold. What do you think?
I don't think we will. I don't think we will. But we have to. We have to. What's that?
What is China? The gold is running not because of you and I. It's running because of central bankers.
That's my view too, Francis. I agree.
If the treasury market is doing and the dollar is doing what Henrik is saying, and you're having a 40% drop in gold, if you even just get to a 20% or a 15%, what do you think China and Russia are doing with any dollars or treasuries they hold? That's amazing. Thank you for the liquidity. Have it all back. These guys, China is a patience trader. They are not a trader. They're a patience investor. They sleep on the riverbank and wait for the dead bodies of their enemies to come by. That's
why I think it's ultimately
that will absolutely unload everything into wherever
I agree.
the sudden liquidity is coming from. So how do you get a 40% collapse with all the major central banks, probably including Switzerland, which is supposed to be a friend, but was also been accumulating gold? Every major central bank, which is the key move the needle gold buyer, on a 40% drop. So we're at 3,300. You're talking 1,700, 1,800. Great. They're going to load up and they're going to get rid of all those treasuries. They'll be doing it long before you get that 40%. And I think
I don't think
telling
it tops
people-
yet. I think it has a little more a higher move than before we top, but I think the top is in around 3,700 or something like that. And then I think you're going to see with the Dixie spiking up like that, you're going to see a very large decline. And again, into a deflationary bust like what we could see here, everything is overvalued. We agree on that.
Yeah.
Everything is
Who's
overvalued.
selling the gold and who's buying the treasuries?
But it's not.
Who's
It
the
will be
idiot
about.
trader?
Because you'll also have a situation potentially where there will be, you had a situation also where gold actually dropped because there was at least the rumors said there was a hedge fund, in problems and they had to go sell gold and you saw a large decline in that gold. I can't remember when it was. It was not so long ago. So things can happen. If the floor opens up and a lot of people are starting to lose their money on their crazy crypto investments or whatever it's going to be, or their hedged long
That's retail.
leveraged.
That's not central.
No. But
This is good. This is
Exactly.
good.
But
This is good because it's
they can be
important to have a disagreement on
corporations
the
as well.
DXY. We agree on
What
gold,
we're
but
actually
this
saying is crypto kiddies that are losing money on crypto, who happen to be big gold holders, are now going to be selling their gold, and they're going to crash the gold market in an environment where the
It can
central
also be
bankers
sovereign
are
state. It
fixing
can
the
also be
price.
sovereign nations that can be in problem. Can get in problem if you start to see that they're the
They'll
yield
do
levels are
swaps.
specking off.
But Henrik, are you saying that in this event where the Dixie spikes in this short-term window of shit happens, excuse my French, is that going to be driven more by a need to sell gold for liquidity, or driven more by a need to buy U.S. Treasuries as U.S. dollars for safety in that moment?
I don't think there's either or. I think there's there will be a plethora of things. I think it'll be driven by the need for liquidity, and the only real liquidity is where the debt is denominated in, and that will be denominated in dollars. You can't pay off your debt with gold. You need to sell gold, and the thing with gold is that it's fantastic to give you liquidity when you need it, and that's what it's there for. So you'll probably see that the sell-off will be something
what
that will be
happened
forced.
in 2008. I'm just trying to find
Arguably, which is the 35%
but
decline you
unlike
had
2008, I'm just trying to. I'm not saying this isn't a foolish argument.
No,
you're
that's
making.
fine. We just
unlike
discussing.
2008 though, today in 2025, the mood, the need, and the status of gold, not just in the headlines, but literally at the BIS, literally at the Fed, even all this nonsense and discussion about gold-backed U.S. dollar again, and not to mention revaluation, not even going down those rabbit holes. What we're seeing with the use of BRICS gold as a trade settlement for net settling, what we're seeing in the oil trade, what we're seeing with the stacking of physical gold in the East, don't you think the environment from the BIS to the Shanghai Exchange to the SPYMEX in St. Petersburg is so different now than in 08?
Henrik suggests gold isn't in a bubble, but simply preserving value as fiat currencies weaken. Its rise may reflect a fiat bear market rather than overvaluation. Silver, platinum, and miners lag behind. Some argue gold has front-run inflation fears and could pull back if the dollar spikes, like in 2008. Others note it hasn't reached inflation-adjusted 1980 highs, and with record global debt, gold's long-term fundamentals remain strong. The broader view is that gold has solid fundamentals, unlike Bitcoin, which some describe as a bubble driven by speculation. Gold is backed by decades of central bank demand and its historic role as real money. Analysts like Francis, Matthew, and Henrik collectively highlight patterns where gold has outperformed stocks after major crises, comparing today's setup to 1929, 1971, and 2000. While a deflationary bust could temporarily make the dollar everything, forcing some gold liquidation to cover debts, the longer-term trend still points to dramatic gains. With projections as high as $35,000 by the early 2030s, gold's role as a hedge against excessive debt and fiat debasement seems more relevant than ever. Now let's get back to the interview.
What if gold is not in a bubble at all? What if gold is simply doing what gold does best, and the only thing that's in a bubble is the U.S. dollar or the yuan or the yen?
Somebody should have told platinum, silver, and GDX.
I think the GDX, I think platinum, platinum's another conversation. I think silver always is the little speedboat that can once gold hits a bull market, but gold isn't in a bull market yet. That's why silver hasn't taken off.
But I think silver actually looks even worse than that. And we also know that normally when we have a real gold bull market, we'll see silver follow. Silver is not at all-time highs yet, and there's nobody who can tell me technically that this looks strong for silver.
Early stage.
No. This is actually late stage. This is late stage if you look technically. You have that the silver is making lower highs on a weekly basis when it moves higher. That tells us that you are moving into a level where it's probably, and I'm saying it's around 41, 40 something, 42 maybe.
Yeah, but that's
where
a
you're going to
different
see
point.
a
I
decline.
also see silver being rejected in the 40s before running 50.
But this is actually a very big rejection. And it
No, but
just
I don't see
doesn't
it
make sense.
being a big
It
one.
doesn't make sense. It doesn't make sense that, but gold should just keep moving higher. And silver, by the way, gets rejected at levels which are far lower than the all-time highs. And by the way, minus does the same, and so does platinum. So what if the most rational explanation is actually that gold has been front-running things a little here, because everybody's been talking about inflation and how that is a problem, and that is a problem.
Devalued. It's artificially devalued.
And that is why it's going to have a relative larger pullback when the DIX is going to, when we go through this whole shit.
There's an industrial component to silver,
Okay,
number one. And
that's my perspective.
I get your perspective, Henrik. I get your
That's my
perspective.
perspective.
And hyperstagflation, there's an industrial component.
We're not
to
stagflation
silver.
now. We
And
2.7%. There's no stagflation.
We are absolutely not getting consumer buying. So there's not the same.
But we have
degree of
2.7%
industrial
inflation. We have 2.7% inflation. That is low historically.
You've been
very,
given
very
a
low.
number of 2%.
But you don't actually believe that's the real inflation number. And silver priced in gold terms is still very cheap, as is platinum. And technicals, you guys are far better than me, but we're at a 45-year cup and handle for silver. I think silver's just waiting for gold to actually have a bull market. I don't think it's a bull market. Gold is kind of itself in a bull market, maybe a little bit inflated, hyped, front running, and that the real, and I'm simplifying that, when there's a real moment, that there'll be an 08-like sell-off, because 2025 is very similar to 08. I would argue it's different. But if you were to change your thesis, it's a little bit, if you could think of, and maybe you don't, that it's not that gold is in any kind of a bull market. If anything, gold is doing what it always does, which is nothing. It just sits there. Well, fiat money is very busy, and sovereign debt is very busy debasing fiat money. And what we have is a major, I think, fiat bear market, and a bull market for gold is simply waiting for the fiat to die.
That we agree on.
But you don't think there's a difference in degree? That you still think the gold is overvalued given the level of U.S. or global debt? You still think it's overvalued?
No, I think, as I said also, I think gold is going much, much higher.
Yep.
I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I just want to say, like when I'm talking to Bitcoin guys also, I'm saying, guys, I know the saying of the institutional adaptation and all these things, but by the end of the day, I think it's a bubble. Okay. And I think that's the way it is. What I see with gold is that I think gold has a fundamental and it's going to also, if I look at Bitcoin gold actually ratio, you can also see that there is something to that. Bitcoin was outperforming a little more, and then you're going to see gold actually taking over again. If you look to the SPX versus gold, you can also see that we have a similar situation like what we had in 1929, in 2000, and in 2000 actually, and also 1971. Sorry, also with Nixon. So we have a unique situation here where yes, gold is going to outperform in the longer time frame. That is if you take the dollar out of the equation. But that's not what you can do in a deflationary bust, because that is when the dollar is everything. The dollar is everything, because you need to pay your debt. So if I get it right,
when you say the dollar is everything, you're saying the debt instrument is everything too. You've got to talk about both. Who's buying the debt?
Yeah,
this is the
gold
bubble, apparently, according to you, at the moment. How can you? I don't see how technically you can say that. We haven't even reached 2000. The 1980s
no,
high.
I'm not.
This is adjusted for the fake statistics that you like. The BLS, these are their stats, dividing by the CPI. And that's where you are. You haven't even met the CPI adjusted high of 1980. And we are in 130% of debt in the United States, 39 trillion, where we were compared to in 1980.
While short-term volatility and even sharp corrections in gold remain possible during a deflationary bust, the long-term outlook remains overwhelmingly bullish. Central bank accumulation, rising debt burdens, and fiat currency weakness all reinforce gold's role as a core store of value. Whether or not interim sell-offs occur, the trajectory toward dramatically higher levels, potentially $35,000 by the early 2030s, reflects gold's enduring importance in an increasingly unstable financial system. If central banks continue to buy aggressively, could they prevent any major gold correction despite a dollar spike? How might silver and other precious metals respond once gold officially enters its next major bull phase? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.